Alrighty, looks like we are going to get started now. Again, thank you for coming to our webinar, The Role of Alternative Financing and Overcoming Capital Shortages, hosted by Founders First. My name is David Gutierrez. I am the marketing coordinator here at Founders First Capital Partners. For this webinar, our expert panels will be shedding light in the prevailing challenges faced by businesses in accessing traditional forms of capital and exploring how alternative financing can serve as a viable solution. By understanding these options, both business founders and financial brokers will gain valuable knowledge on alternative financing methods that can provide growth capital even in the face of stringent qualification criteria. And then just as a reminder that after this webinar, we'll be sending out the slides. So in case you want any of the information presented, we'll be provide that to you as well. And then just give me one quick second. And then here are our presenters. We have Kush Kakai and Oscar Franco from the Founders First team. I'll hand it out to them and then they'll do the introductions and we'll get started.
All right, Kush, go ahead.
Wonderful. Good afternoon, everyone. I hope you guys are having a great week so far. My name is Kush Kakai. I am the Business Development Officer here at Founders First Capital Partners, really in charge of sourcing and qualifying some deals for us. And I'm going to pass it over to my coworker, Oscar Franco.
Perfect. Thank you, Coach. Oscar Franco, investment manager here at Founders First. Been with the company. I'm getting closer to my second year anniversary here. My role is essentially reviewing all the deals that come in the right pipeline. A little bit more about myself, working with entrepreneurs essentially all my life, from incubators, accelerators, VCs, and now here at Founders First. And a pleasure to being with all of you. Perfect. Next slide. There you go.
Wonderful. Well, so just to give you guys a little bit of a glimpse into, Founders First as a whole, really who we are is we are a very mission-driven impact fund designed really just to help solve some racial and socioeconomic gaps that we've noticed in this in the past few decades when it comes to raising capital for entrepreneurs. Really what we have kind of focused in on is our revenue-based financing loans that we provide, along with also our nonprofit side, where we host various different business accelerator programs designed to really help them grow and scale up their businesses to their desired revenue outcomes. Really our target market that we serve is really B2B diverse-led businesses, anywhere from companies that are, between $50K to $10 million. If you can go to the next slide, David. Wonderful. And so we've been around for about 8 years now, almost 8 years now. And really it's been a tremendous, tremendous opportunity to be able to work with such incredible companies and entrepreneurs throughout those past 8 years. We've worked with over 700 companies so far, and really just wanted to highlight some of the statistics that we've had on our impact on the companies that we've worked with. And it's just truly so incredible to see this diverse landscape of businesses really being able to grow and scale up with the support and capital that we've been able to deploy out. And I'll pass it off to Oscar.
Perfect. Appreciate it, Coach. Thank you. So one of the things we wanted to chat about with you guys is essentially some of the most recent challenges that we've seen so far in essence, access to capital for underrepresented founders. So if you go to the next slide real quick. Perfect. So by the way, this is just a few of the things that we wanted to share with you guys. And I wanted to sort of dive in a little bit closer into 4 specific things. One of them will be like economic uncertainty, as we all are aware now. But I think once when COVID was started, I think no one could imagine what the magnitude of what COVID will essentially bring to not only businesses but to our lives in general, right? Political instability are other factors that necessarily are not in our control, but investors really take into consideration into their deployment of capital decisions, right? So that uncertainty that is out there. It's definitely some of the things that entrepreneurs need to be facing at the moment, right? Regulatory restrictions, again, another thing that is essentially not in our control, but every year, every day, there's some regulatory concerns about whether it's fixed amounts, terms, regulations in terms of industries. So there's a lot of things going on in this particular sense that, again, this is not in our control, that entrepreneurs, we need to make sure that we are up to date with those things. And because investors are actually taking it into their investment decision. Market consolidation. And I think this is just a great example, and not so long ago, right? With essentially what happened with the Silicon Valley Bank, where essentially there's bigger players that are actually acquiring some regional or more quote unquote traditional banks. And this is just a consolidation that obviously is make their presence even bigger in the industry, but for entrepreneurs, it means that there's some less options for them to access for some capital, because in essence, the negotiation will be with the same usual suspects that they were trying to get access to for a long time, right? So, and by the way, this is a very common practice, not only here in the US, but abroad. And honestly, moving forward, we can expect something like that to continue to happen. And I would say just lastly, investment behavior. And this is one of the things that I really want to like focus on a little bit more in depth. Like I said, I've had the opportunity to work with investors for a while now, not only here in the US, but abroad. And there's some like major concerns on this specific line item, right? They are currently rethinking valuations of companies. I'm sure you can think about some companies that have some humongous figures as far as like valuations that essentially put into jeopardy some other companies that are sort of in the similar industries in order to hit those numbers, right? Those companies that have higher valuations are expected higher returns, and we're not seeing that. Sorry, investors are not seeing that type of, specifically equity investors haven't seen those types of returns. The current IPO drought. I was reading a recent article that in comparison to other years, there's a huge drought in that sense. And I would say, lastly, just exit opportunities for entrepreneurs. You need to remember that investors, one of the ways that they make money is by like exiting those opportunities, right? Whether it's through IPO, companies continue going into the fundraising rounds, or possible acquisitions. Those things that are in general have been drawing up recently, specifically last quarter of last year and the first quarter of this year. So if you can help me out going to the next slide real quick. This is another slide that we really like to showcase here at FounderSource, because when I have an opportunity to connect with investors or brokers, they always try to figure it out, like, okay, where do you guys position yourself sort of in the landscape of funding opportunities for entrepreneurs? And this is like I think, my opinion, a perfect way to put it out. So on the left side, you have your more, I'll say, traditional types of loan, obviously. So the usual suspect, your banks, SBA loans, which are most of the time asset-based lending types. They are very rigid as far as their investment criteria, and unfortunately, not all companies are a good fit for it, right? Whether it's from revenue size, or essentially because they don't have any assets to collateralize to it, right? On the right side to that, your MCA loans. Those are very easy to get. You get that money in 24 hours, 48 hours, very minimal approval, which is high and ridiculous interest rates, right? There's a time and place for all types of funding. In my expertise here at Founders First, I've come across a lot of companies that have MCA loans. We completely understand that when it gets a little bit tricky is when they try to make long-term strategic decisions funding their company using MCAs. That's where it really gets tricky. Now, on the right side, you have your equity players out there, right? From equity investors, crowdfunding, VC capital. Those are a perfect fit or a perfect opportunity for funding for entrepreneurs that are specifically anything related to tech or a tech component to their business model. Their expected high growth, 10x, 20x. And unfortunately, not all companies have that business model, right? Specifically, those companies that are a little bit more traditional on the service side, maybe they cannot expect those high or very aggressive growth rates. So we like to position ourselves in the middle. As Kush mentioned, one of our products, revenue-based financing and term loans, are essentially loans, but there's some services components that an equity player can bring that Founders First can also do with the entrepreneurs, right? Whether it's through our programs on their nonprofit side, or by providing specific services, growth services for the companies that we invest here in the company. And so with that, I'll pass it along to Kush to help us go through the next slide.
Here's Oscar. Appreciate that. So kind of going off of what Oscar had said previously, we've been seeing a very, very large growing need of alternative capital for these growing businesses and startups. Typically, if you look at companies in the traditional tech or SaaS space, the obvious route that they have for growth and expansion is to go through an equity play. They have the network, they have the resources available. However, as Oscar mentioned, throughout the pandemic, with all the overvaluations that have been happening, now equity partners are not really the best option for them. And now it's actually, a lot of entrepreneurs and small business owners are starting to rely more on, other forms of financing, such as revenue-based financing, to be able to really help their growth. David, if you could go to the next slide, that'd be lovely. So here are just a couple of the industries that we at Founders First have been able to kind of recognize some of the growing, need for capital. Obviously, with the rise of, having, not having in-person meetings and such, you have companies such as, Zoom and Slack that gained so much traction throughout COVID, and even companies such as, Coursera, adapted to these new changes and these new social norms that we had. Something that we also noticed was that, the healthcare industry as well went through some insane and drastic changes to be able to, just be able to stay afloat and to also be able to thrive. A lot of really, really great technologies have been implemented into their business to be able to compensate and to be able to really stay afloat throughout these, tough, difficult times. And lastly, security firms have been something that, have been something that a lot of companies have really been growing and starting to, need this for, need their services to be able to support their business, and such. I was living in San Francisco for the past 2 years, and just with the growing crime that's happening in that city, I saw firsthand so many more private security firms that were being hired out for these smaller businesses and even larger businesses. So there have definitely been some shifts in terms of some of the industries. And these were just 3 of the different industries that we saw firsthand, differences in since COVID had happened. And I'll go ahead and I'll pass it off to Oscar for the next slide.
Perfect. Thank you, Coach. Now going into more specific details of one of our rockstar products, RBF. Revenue-based financing, for those that are not familiar with this type of lending product, is an alternative model that supports growing businesses' need for capital. And I would say one of the benefits about it is that, one, there's not an equity component, right? So for those companies that have traditionally gone the equity round, there is no equity component in here in this type of deal. And specifically for those companies that are not necessarily ready to go into the traditional lending route, to your traditional, let's put it this way, a traditional bank loan, revenue-based financing could be a great fit, right? So let me just go into some of the details of the differences, or some of the most frequent questions that we get. Is RBF a merchant cash advance? 100% is not. And you're going to notice that immediately once you sort of compare one of our offers versus the MCAs out there. MCAs out there, there's interest rates that are over, I would say 50, 55, 60%. We're not even close to those numbers, right? So there's a big difference in terms of what we do in our terms and in our agreements in all of our loans. Asset-based lending, as I said before, all of our decision-making here at Founders First is, I would say, almost 100% based on out of the company's performance. So we don't ask for any personal collateral from the founder, right? We don't go after their house or anything like that. Factoring, we do not purchase invoices or anything like that. So the best way to describe revenue-based financing is think about it as a term loan, but instead of having a fixed payment on a monthly basis, we take a percentage of the company's top line revenue, and that's how the companies pay the loan back. Here's just a few of the benefits of essentially going the RBF route. I know Coach is going to go a little bit further into sharing a little other essential benefits, but long story short, there's a very lower cost of capital. It's non-dilutive capital. It's long-term strategic growth capital for the companies that we work with, meaning that we like to position ourselves as long-time debt providers, right? So we're going to go into more details later on. I don't want to spoil any of the information that we're going to share in a minute, but long story short, we can provide a first loan, and we can do follow-on investments as well, right? So the idea is that we can be that source of initial capital for you. So once you become bankable, let's put it this way, or get access to other alternative options out there, you'll be in a much better position to go after those. And with that, I'm going to pass it on to Coach, who's going to go a little bit further into some of the benefits of doing RBF.
Definitely. Thanks, Oscar. You can go to the next slide, David. So I know Oscar had, touched on, some of the advantages that we have on RBF, but, I really just wanted to kind of drive home some of the really, really key important facts of our financing models that we have. Firstly, just wanted to say, we have very, very limited financial covenants. What we are trying to do here at Founders First is try to provide some sort of flexible capital that is very conducive to the growth of the company. The last thing that we want to do is we would want our capital to be a financial burden for the company. And we really want to be sure that we are doing everything in our power to not hinder their growth. So with that, the fact that we have zero dilution of their equity that they have is a huge, huge selling point for us. We have a very aligned interest in the company's performance. As Oscar had mentioned, we secure and we look at the company's historical financials rather than, what assets they have in their business. So because of that, we also don't collateralize any assets. We don't require and we don't put any personal liens on the property or the borrower itself. And, the biggest thing is, for companies that are looking to go through some sort of successful exit or maybe even have some sort of equity play in motion, you will be able to retain as much as you can so that when you are at that point or when your client is at that point to explore equity options or maybe even an exit or an acquisition, they will have as much equity upfront and they'll also have the very, very strong business structure for them to be able to have this exit. And lastly, as Oscar mentioned, we try to make sure that we have a lot of wraparound services that are tailored towards the businesses that they have. Our capital that we can inject into the company is only half of what we are trying to do. And really, as I mentioned, our aligned interest that we have in the company's performance is really what's going to help us and the company move forward. And so if you guys would like to learn a little bit more so about the advisory services or networking opportunities that we have for your clients, we can touch base on that offline through a meeting, or if you guys want to touch on this at the end of the call meeting, we can also do that as well. Then David, you can go to the next slide. So just wanted to give you guys a little bit more so details onto some of the business characteristics for our ideal type of companies that we have. So typically we like to see companies that are doing anywhere around $1 million plus in annual revenue. For some states that we have, we can go as low as $500K for them for their annual revenue. But I would say on average, most of the deals that we fund are between the $1 to $10 million range in terms of annual revenue. So as we are a mission-driven impact fund, we want to make sure that the business owner or someone on the C-suite meets one of the following minority requirements that we have listed here. Ideally, we'd like to see companies that are profitable or break even, and we have at times worked with companies that have a very, very clear path to profitability. As I mentioned, we do focus on funding B2B companies. And the reason why we do that is because we like to see very strong growing revenue or very, very strong recurring revenue in place. I want to reiterate that because that is a huge, huge part of our discovery that we like to see, and the types of companies that we look for is really companies that have that consistent monthly revenue, recurring revenue throughout the duration of the year. And then our official minimum that we have for time in business is 12 months. However, we would like to see, ideally, we'd like to see companies that are a little bit older than that so that we can, when we are doing our financial analysis, we can have a little bit more data for us to be able to work with. Now, in terms of, the specifics of our loan products that we offer, term lengths can go as low as 12 months and we can go as high as 5 years. Oscar, correct me if I'm wrong, but I believe our average is around 36 months for some of the terms that we have, for some of the term loans and revenue-based financing loans that we
24, 36, usually around those.
Perfect. And then in terms of funding amounts, we're looking at anywhere as low as 50K. And then we can go up to $2 million, with the exception that the first tranche will be capped at $1 million. And we can provide follow-on funding going forward up till $2 million. And, I guess the next couple slides that we have will be going into a little bit more so about our funding, about our specific funding amounts that we have in specific funding types. But you can go to the next slide, David. Now, for our excluded industries that we have, as you guys can see the following, anything that is cannabis related or cannabis adjacent, something that we cannot move forward with. Weapon sales, distribution, or manufacturing, we cannot work with. Anything that is, in the gambling space, also online sports betting, that's something that we cannot work with. Any company that revolves around liquor sales, so that would include bars, nightclubs, restaurant groups as well too. That's something that we are not able to invest in or provide capital to. And lastly, nonprofits. So I know I had a lot of different companies that I just reiterated and I just said that we can't invest in, but what are some of the types of businesses that we really, really like to see are very asset light, service-based businesses, right? So for instance, veteran security operations is that type of business is something that works really, really well for us. We are continuing to push really, really hard to fund a lot of tech companies. So whether they're, pure SaaS, pure SaaS business, that is really, really good for us and works really, really well with our funding types. But also companies that are, tech adjacent or provide some sort of tech solution is something that also works for us. Really, at the end of the day, I really want to just reiterate the fact that we are looking for asset light, scalable service-based businesses. So, a lot of, say, for instance, one industry that we had here that is a little bit tricky for us is trucking, for instance. Trucking, most of the time is very, very asset heavy. And, typically in the past, we haven't really been able to do much work in that space. So that's why we're looking for companies that are in more so the asset light space, such as consulting businesses, tech companies, other service-based businesses such as that. You can go to the next slide. So to go into a little bit more detail on, a specific funding example that we have here, we've laid out an example loan that we have for our revenue-based financing model. And just to reiterate, the biggest differences that we have between revenue-based financing and term loans is that there is that, it's a variable monthly payment with a set, I would say it's close to a royalty rate. Typically, that's anywhere between, as it mentions, 2 to 5%. Of what their monthly recurring revenue is. And that 2 to 5%, whatever that set rate is what we are going to be taking out to pay off the loan every month. Now, as you guys can see, for companies that, might experience some seasonality in their revenue or might have some fluctuation in their revenue, some dips, this is a really, really attractive offer because it's not as much of a financial burden as, say, a set fixed monthly amount that's coming out every single month from your guys' cash flows. So additionally, I also just wanted to mention too that, we really, as I, wanted to reiterate the fact that, the performance that the company has is something that we are really, really, really aligned with. And so because of that, if they are in a place where they're growing fast and they're able to make a lot more payments and higher payments, there's zero penalties if they pay it off early. And then on the flip side, if they need to extend their term, we try to make sure we we work with them as best as we can to make sure that we are not, as I mentioned, being a financial burden to them. You can go to the next slide. As you guys see here from our term loan example that we have, it's a set interest rate that we have, and it's a fixed monthly payment that is going to be going. So both of these examples are for the same amount and the same type of business, as you guys can see.
Yeah, just quickly going back to the RBF example, I always get asked this question about interest rate for that one. So given that we are sort of basing it on projections on when the company is going to hit that principal plus interest based with that royalty fee, it's sort of impossible to generate an interest rate from the get-go, right? Once the principal and interest is completely repaid, obviously now then we can calculate an interest, but it's also, so let's remember that interest, it's an indicator that it usually takes time into the consideration, right? So time and an RBF, our average, as Coach mentioned, is, I would say, between 2 to 5 years. So that will depend on the company's performance. They are achieving their projections and whatnot. So I just wanted to make that clarification as well.
Thanks, Oscar. Appreciate that.
Perfect. And just a couple of follow-up questions just to continue the conversation. Kush, if you don't mind sharing some of the industries that have reached out, specifically recently looking for alternative capital.
Yeah, definitely. I know I touched on this earlier on in the webinar, but we've been seeing, and I specifically have been seeing a really, really growing need for alternative, specifically revenue-based financing for pure SaaS companies. As we mentioned and as we touched on, earlier in the call, the equity landscape is drying up a little bit, and there's a lot of different changes that they're making. Also, just in general, I think founders as a whole are starting to recognize the importance of retaining value and retaining ownership of their company. And so this has been something that's been huge for us because we are non-dilutive. It's a really, really great and attractive offer that we provide to these businesses and to the brokers that we work with who refer out these businesses. Also, one thing that I've been noticing a lot more so recently has been some interesting e-commerce businesses that have more of a retail side to them. So that's something that, we definitely take a look at and we try to see what we can do for the companies, but that's been something that I've been noticing is a lot more CPG, e-commerce related businesses with retail channels has been something that I've been seeing a lot more so. Wonderful. Oscar had a question for you as well. So what are some of the, what are some of the steps that businesses can take to improve their chances of approval for alternative financing, especially if they're in a less than perfect credit, when they have less than perfect credit histories?
Absolutely. And I remember when we were prepping for this, we only have like 10 more minutes, so I want to make sure I'm brief, but there's multiple things, right? But I would say it's not in order of priority, but some of the things that I think are really, really important. I would say one is have a very strong business plan related to your company, right? That means that use of funds in relationship to the funding, growth opportunities that you're spawning on in your business. Essentially, what does it need to happen to take your company from A to B? Getting that information, getting that clarity on that story, even if there's a lot of hypotheticals to it, but that'll definitely give us certainty as lenders to know that there's a path forward here in this business, and that obviously I would say in a more basic way, you know what you're doing, or the companies know what they're doing, right? And that's number one. Understand your credit situation as well. So if you have any current loans in the business, understand like what's the original amount from those loans. Are you making payments in time to those? What's your current credit situation with them? Any information you can provide as far as like interest rates, repayments, what's the current outstanding balance with them? That is super important for all, and especially in the beginning of the conversations, to make sure that you have that information in hand. As you know, cash is king, right? So having strong positive cash flows, I think this is very important. And sometimes companies, I don't want to say they don't necessarily pay that much attention to it, but obviously they are so caught up doing a lot of stuff in the business that I think sometimes this gets sometimes forgotten. Making sure that you're constantly monitoring your cash flow in the company, right? So essentially, out of everything that you're related to your expenses, how much money is coming in, and making sure that you have a healthy ratio in there is super important, because that will sort of give us some clarity that if we provide you with some funding, that you will have the resources to pay it off, like as well. Having your financials in order, that's also another thing that is very important, right? Especially for those clients that are not using already any accounting software such as QuickBooks Online. I think this is very important, right? Having some certainty, clarity, like I said in the beginning, I have the opportunity to essentially review most of the deals that come here through our pipeline, and you'll be surprised of some of the financials that I get to see, right? So making sure that those are in order, that are ready to review, it's also very important. And I would say just lastly, be transparent and be proactive in your search. So transparent in a way that if there's any red flags that you already know behind your business, be transparent about it. A good example would be, I remember back in the day, I was reviewing a company, everything was going great. But once we went into tax liabilities, we noted that there were some tax liabilities in there, right? of course, the founder had some sort of idea of some, but not essentially the total amount that was actually outstanding. So those things can not necessarily take us a step back because we need to do further analysis to it and making sure that the investment committee is sort of comfortable doing that. But just being transparent with stuff like that, if revenues are declining, sort of have a, what's the story behind it? I'm sure there's something happened. You lost a client, you lose a big client. Is this just the industry? Is there any data that you can back it up that the industry is sort of in decline? And be transparent about it and be proactive in your search as well. I know companies that are currently fundraising, whether it's equity, lending opportunities. If you're exploring other options, just let us know as well and let us know your timeline. If there's any specific timelines that we need to be aware of for your fundraising activities, let us know. That was definitely super helpful information for us. Those are just a few. Obviously, I can elaborate a little bit more on some other topics, but I will say those are primarily one of the things that I wanted to share.
Amazing. And Oscar, last question. Can you explain our typical time frame for approval and funding when utilizing alternative capital?
Yeah, absolutely. So I'll say long story short, approval is anywhere from, we'll say 3 to 5 weeks, more or less. But I really want to make myself clear. A lot of it has to do with how fast we can get the information or the questions answered from the client, essentially. Like I said before, we have some clients that have done some lending or fundraising in the past through equity. They have everything spot on and ready to go, right? And all the financials are in order. So if we ask for a report, if we ask for projections, they send it over immediately that day, right? There's some other clients that need a little bit more work on. So there's obviously there's some time differences between depending on how fast we're getting that information in direction with your client. We'll try to make sure that we are moving fast enough so that we are getting closer to a closing as fast as we can. But obviously, if you want to have that conversation with your client, just to make sure you're on top of things, that would be super helpful as well. Yeah,
Alrighty, perfect.
Yeah.
So now we'll move on. Now we have a few more minutes left. We'll just do a few questions for the Q&A section. As for the first question that we have, we had a question that said, you mentioned you are a mission-driven organization. What does that mean?
Sure. Because you don't want to take that one?
Yeah, I can handle that one.
Oh.
So really what a mission-driven organization is really just essentially what we have done is we have committed to our investors and just as a whole, our value proposition as a firm has been committed to being able to complete a mission that we have set for ourselves. Our specific mission that we have set is to be able to fund minority-based businesses. That's our mission. That's what it means to be a mission-driven company. Some people have other mission statements, such as maybe a diverse hiring, DE&I initiatives, diverse hiring. It really can mean a variety of different things, but essentially for us, what it means for us is for us to be able to level the playing field for access to capital and resources to minority-based and founded companies.
Alrighty, perfect. And then for the next question, for 100,000 monthly gross for an 100K loan, what would the estimated monthly payment be for that?
Yeah, I can take that one, Chris. By the way, I love that you already have a deal going on right now. We can most definitely take that conversation offline for sure. So feel free to reach out to us and we can take a closer look at that particular deal. The reason why is just there's some variables to it, as Chris would mention. If we're looking at it from a RBF perspective or a term loan, how recurring, how predictable is that revenue model? So there's a lot of components essentially to answer that question, but more than happy to jump in on a call with you, try to understand a little bit more about this opportunity to business model. And hopefully if there's a path for us to move forward, start working on a potential deal for sure.
Alrighty, perfect. So ready to partner with Founders First Capital Partners? Work with Founders First to get your small business clients the funding and support that they need to take their business to the next level. Right below, you have Kush and Oscar's contact information and their emails and phone numbers to reach out to them if you have any questions. Again, for all the attendees, you will be receiving slides and a follow-up email so you can have access to all this information regarding alternative financing, our financing options, and also the contact information to reach out for any further questions and see if any of your clients can benefit from alternative financing. And then make sure to check us out at foundersfirstcapitalpartners.com for more information. And with that, we thank you for attending our webinar this month. Again, thank you to our panelists, Oscar and Kush, for providing such great detail regarding alternative financing. And make sure to look out for that follow-up email with the slides and all of the information regarding this webinar. And we look forward to seeing you in the next month's webinar. Thank you.
Thank you all for
Thank
joining.
you, everyone.